From ImpactAlpha, it's This Week in Impact, where we bring you some of the most interesting impact investing and sustainable finance stories of the week. It's Friday, April 4th. I'm Brian Walsh, and this week I'm joined by ImpactAlpha editor Jessica Pothering. We'll discuss an innovative climate insurance pilot in California giving landowners incentives to reduce wildfire risks. Plus, making concessional capital smarter by targeting Africa's farmers and the funds that support them. That's all coming up on This Week in Impact. Hi, Jessica. How are you doing today?
Hi, Brian. It's great to be back. Thank you.
Great to have you back. Well, first up, the news in the year 2025 sure does move pretty fast, but we all still recall the historic wildfires that devastated parts of Los Angeles and other areas of California earlier this year. Jessica, you wrote a piece this week about a pilot project near Lake Tahoe that offers financial incentives to landowners for implementing wildfire mitigation measures. Tell us who's behind this pilot program and why it caught your attention.
This is a part of an insurance initiative by the nonprofit conservation organization, the Nature Conservancy. They've been actually for the last 10 years or so looking at ways to leverage the insurance market as a financing mechanism for nature conservation. And they've designed a few kind of interesting insurance policies that are a shift away from the normal way that insurance is underwritten. And this latest model, basically what it's trying to do is look at best practices in forest management and to help property owners implement those by incentivizing them with lower premiums on their insurance and lower deductibles in case a wildfire does strike their property.
So interesting. So tell us about this specific pilot project near Lake Tahoe.
Yes, this is work that the Nature Conservancy designed in partnership with the insurance provider Willis and the University of California, Berkeley Center for Law, Energy, and the Environment. And it's a $2.5 million wildfire insurance policy for the Tahoe Donner Homeowners Association in Truckee, California, which is close to Lake Tahoe. And what it does is, in order to incentivize Tahoe Donner to implement some forest management and land management practices on the 1,300 acres of land where those homes are based by doing things like tree thinning or just kind of clearing flammable debris and some other, established practices, is it in turn gives them a 40% lower premium and a 90% lower deductible on the policy than would be otherwise available to them in the market.
So they kind of help proactively reduce wildfire risks by encouraging the property owners to adopt these preventative strategies and therefore potentially decreasing the future damage as well as the future insurance claims should a wildfire strike this area.
Right. And what I should say is actually the things that they're asking Tahoe Donner to do are things that the Homeowners Association has actually been doing for the last 10 years. So they're pretty experienced at this already. But what's significant about it is this is the first time that they have figured out how to price prevention into a property insurance policy. So what the Nature Conservancy did a few years ago was they undertook this study to see whether or not actually there could be a correlation between preventative forest management practices and the risk or cost to insurers in the event that a wildfire strikes. And they found that actually there is a correlation to that. That if you sort of proactively manage these risks, that the extent of the damage and the severity of the damage would go down. So, of course, the cost of what insurers would have to pay out would also go down. And in a place like California, where the wildfire season's getting longer, the fires are becoming less predictable, insurers in many cases they're canceling a lot of existing policies and they're pulling out of some markets altogether, right? So insurance is becoming not only more expensive, but harder to secure. And so what the Nature Conservancy is trying to do here is prove to the insurance market that there are other ways to do this, to stay in these markets, and to ensure that there are plans for property owners that work for property owners, and that will also work for the insurance industry to ensure that insurance coverage is able to continue as the climate changes.
And so by working with this global insurance company, Willis, that they are able to kind of prove the model or hope that there is further uptick among the insurance industry to adopt these kind of win-win solutions with the kind of alignment of incentives that the people that are buying the coverage are also incentivized to take preventative measures to prevent forest fires.
That's right. And so this policy design is different than the way insurance normally works. This is normal insurance, indemnity-based policies. The process is when you buy a policy, you're covered for certain things and certain types of damage. You pay a premium for that. You pay a deductible if something happens, and then you file a claim, and your insurer reviews the claim and decides how much to pay out or whether or not to make a payment. And in this case, they're sort of taking that whole complicated and costly and time-consuming claims process off the table by saying, if there's a wildfire that strikes this area, we assume that there's a certain level of damage. And so it triggers an automatic payout. So you skip the whole claims process entirely. And there has been evidence showing that can be a much more cost-effective way to insure against widespread damage in the case of like natural disasters. And so that's called a parametric insurance policy, because it's based on certain parameters being met for a payout. And so that's what this policy looks like. And the Nature Conservancy is arguing basically that as the climate changes and as these natural disasters increase, new ways of underwriting insurance are necessary. And their goal here is to prove to other insurers that this can be a viable model for them to consider as well.
So the change in the insurance model from an indemnity-based payout to a parametric-based payout has been studied in other areas before, correct?
Yes, we've seen some examples of smaller, financial services companies in Africa, for example, using it for smallholder farmers to secure crop protection against drought or livestock protection against other natural disasters. And there's some other companies that are trying it out for flood coverage. So yes, there are more and more examples of it, but they're still operating on a fairly small basis at this point.
This is not the Nature Conservancy's first rodeo when it comes to piloting these kind of models. Is that right?
No, this is actually their third policy. And their first couple were focused on also parametric insurance policies focused on coral reef protection from tropical storms and hurricanes, the first being in Mexico and the second being in Hawaii. So this is the third in their portfolio.
All right, super interesting development here. And thank you so much, Jessica. There's a link to your article on ImpactAlpha.com. We'll also have a link in our show notes. But let's take a quick break. And when we come back, making concessional capital smarter by targeting Africa's farmers and the funds that support them.
ImpactAlpha is going on the road for the launch of our new project, Reconstruction, Building Models for Shared Prosperity. It all starts in North Carolina on Friday, April 4th, at our in-person convening at UNC Chapel Hill. We're teaming up with Good Trouble for a free day-long event focused on the Tar Heel State's impact ecosystem. We'll have a special screening of ImpactAlpha's first mini-documentary, Equity and Ownership, Napoleon Wallace and the Reconstruction of Black Wealth. Then it's off to Washington, D.C., Boston, and New York for more screenings and face-to-face networking with other agents of impact. Be sure to read the brief for more details on each event. Hope to see you there.
Jessica, you wrote this week about the agriculture sector in Africa, which faces a $75 billion funding gap. While some concessional capital has stepped in to help mobilize additional commercial capital, your article raises questions about whether the limited amount of concessional capital is being put to its highest and best use. So, Jessica, help set the scene for us.
Brian, In all the years that I've been reporting on impact investing, I feel like the story about investing in smallholder farmers in emerging markets like Africa, Latin America, anywhere else, is always the same. Everyone talks about how risky it is. These are folks who are underbanked, don't have credit histories, they're working in rural areas. Food and agriculture is seasonal and risky. And so it never seems to get easier from an investment standpoint. There's never enough money moving into that sector. And the pain points don't seem to get much easier over time. And so the story that I focused on this week was a report that's out by the advisory and consulting firm ISF Advisors that takes a look at the private investment players that are operating in Africa about the challenges and pain points and successes of their fund models, really just to illuminate, okay, what are some of those hardships and how can we correct them?
So so ISF Advisors had surveyed 18 funds about their business models, capital stacks, and experiences with investors. And what were some of the takeaways and the key findings of this report?
I spoke with ISF's Dan Zook about this report extensively. And one of the points that he made to me was everywhere in the world, agriculture depends on subsidies. In most places, those are heavy government subsidies. But also those subsidies are needed on the financing side of things as well. And in the US, the US Department of Agriculture has an extensive grants program. In Africa, that type of money isn't as readily available. And so these fund managers that are operating in the agriculture sector on the continent are having to use, subsidy kind of alternatives, whether that's grants or guarantees or other risk, whether that's grants or guarantees or other risk mitigating mechanisms to make the financials of their funds work.
So it sounds like the challenge here is that the relatively small amounts of concessional or catalytic capital that is available go to help support fund managers themselves so they can attract the commercial capital that they need to get to greater scale. But the subsidies don't make their way to help support the farmers and their operations. Is that fair?
It's not actually so much about helping the fund managers. So what this report found is that, oftentimes we talk about concessional capital as being a catalyst for getting private investors into a market that they wouldn't otherwise invest in. And the goal of that is to sort of prove out risks and possibilities to mainstream capital in the hopes that those investment theses will become sustainable with commercial capital over time. And what this report is saying is that in many cases in the agri-food sector in Africa, there won't be purely commercial opportunities. So concessional capital might always be needed. So the question that's being posed here is whether or not a small amount or very limited amount of concessional financing that's available for this sector is best used to try and catalyze or mobilize other private investors to invest in the food and agriculture sector in Africa, or if it's best used to actually bolster the businesses on the ground and better position them to be in growth mode or to improve their resilience and the like.
Right. So in impact investing, we often talk about trade-offs and people try to go beyond trade-offs. But in here, we're already talking about concessional capital that is willing to take lower returns or higher risks. And the question here is, are they making the right trade-offs? Are they backing too safe of models, or are they putting that limited amount of concessional capital? Should they put that limited amount of concessional capital to have a higher impact to meet more underserved companies and farmers?
That's right. And to be clear, this report and the 18 funds that they're looking at is saying that all of these funds are impactful in the way that they're using concessional capital, but some, based on the types of businesses that they're reaching or the types of investments that are offering, might have deeper impact than others. And so one example of that is a fund that's been around for 15 years called AgDevco. When they first started out, they were primarily providing debt capital to very small agribusinesses, and over the years have pivoted to mostly mezzanine financing, and they're doing slightly larger check sizes. They're still operating in a space with far too little capital, and so they're still a very impactful organization. But by changing the type of money that they're offering and kind of going into slightly larger ticket sizes, they're not necessarily having that super deep on the ground impact where finance is urgently needed by very, very small or very, very early stage companies in the way some other impact fund managers are.
So that's AgDevco. What are some examples of funds that are taking a different approach?
Right. So the report suggests actually that some of the agri-finance models that are on that other end of the spectrum that are working, for example, with very small businesses or in markets that are greatly underserved by the private sector or are doing kind of ecosystem building, those types of funds are going to have much deeper impact, but also probably long-term going to be much more dependent on concessional financing. And some of the examples they cite that I like, there's a group called SME Impact Fund in Tanzania. They're working with super small businesses. There's another one called Synergy that has a fund for Burkina Faso, and we just don't see many impact funds showing up in Burkina Faso. And then there are others doing more market-making activity like Aceli Africa. So those are a few of the examples that they cite.
All right. Well, you can read Jessica's full article on making subsidies smarter by targeting Africa's farmers and the funds that support them on ImpactAlpha.com. There's also a link in our show notes. But for now, that's going to do it for this episode of This Week in Impact. Thank you, Jessica.
Thanks, Brian.
And thank you all for listening. This Week in Impact is a production of ImpactAlpha and part of the ImpactAlpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For Jessica Pothering, I'm Brian Walsh. We'll see you next week for more Impact.